a man that just refuses to lower the Fed rate, just refuses to do it. And he's not a smart person. I don't even think he's that political. I think he hates me, but that's okay, you know.
Let's discuss interest rates, starting with the vitriol from Trump to Powell has reached new heights this year. Trump has called Powell a numbskull, Mr. Too Late, a real dummy, a complete moron, a fool, and a major loser, among other names. And, you know, at times I've seen realtors even blasting Jerome Powell for not cutting rates. Well, the Fed doesn't directly control mortgage rates, and it's also not the Fed's job to boost realtors' summer sales. It's to protect the long-term stability of the U.S. economy. Tell us your thoughts.
The last 3 Fed fund rate reductions did the opposite to long-term rates.
Right.
Okay. So we went the other direction. So please be clear that the vitriol, as you say, President Trump and what his opinions are about Mr. Powell and his decisions to keep that Fed fund rate unchanged for the last several meetings that they've had, I think is more of a distraction, but that's another conversation. Overall, I would say that, is he too late? Is he right on time? You know, there's so much data and so many data points that they're looking at, and there's this thing in the industry called a lag, that in truth, they're not getting the actual data points that they need real time. It's lagging. So the data that's coming out to them today isn't going to be what's relevant and necessary to make changes tomorrow, next month, and next week. Most recently, you probably saw in the news, the BLS, Bureau of Labor and Statistics, and the jobs report came in far under what the expectation was. So that might have been the catalyst, I think, that will drive Powell and group to reduce. That is the overwhelming expectation that the Fed fund rate is going to come down. By how much? We don't know. Secondary markets are already baking that in, by the way. So when we talk about long-term interest rates, I'm starting to see some changes on the day-to-day. I get access to that stuff and I'm looking at it daily, the ticker tape of where the treasury bonds and things are. So I'm starting to see some slight improvement in interest rates in preparation of that market expectation. Interest rate on the Fed fund level will probably reduce. But I think overall, Keith, that the Fed is in a really difficult position, because when you think about what really is going to drive the Fed fund rate and then potentially the long-term rate is counterintuitive to what most people or consumers expect, right? They think if the Fed fund rate reduces by 1/4 percentage point, then a long-term 30-year fix should probably reduce by the same amount. It does not go hand in hand like that. Now, while there are trends, right, that doesn't happen that way. So, and more often than not, the worse our economy is doing, the better a 30-year interest rate will be. Okay, so in my industry, I'm kind of always playing on the fence thinking, I don't want anything bad for our country and the economy. However, the worse it does, the better interest rates are going to become. And if you've been paying attention, the economy is in decent shape. We're not doing that bad. Inflation is still up. So the metrics that they're using to kind of gauge and predict that lag and where we're going to be are not in line to say that interest rates are going to drop 1/2 or a point or 1.5 in the next year to 18 months. Those signs are not out there for me. All of that said, I know that interest rate is top of mind for, I mean, I'm on the phone all day long. I like that part of my job where I'm still interfacing with investors on day-to-day. A big chunk of my day is spent talking to clients, and that is one of the top questions, probably one of the first questions that come out of their mouth. Where are interest rates? What are interest rates? And what I have sort of started to really form and say to that question is, if interest rates are the catalyst to your success in real estate, you probably need to do a little bit more research, because interest rates should not be the make or break for your success as a real estate investor. Yeah.
The Fed has a dual mandate of maximum employment and stable prices. Inflation, though still somewhat elevated, has stayed about the same the past few months. And history shows us that the Fed is more comfortable with inflation floating up than they are with suppressed employment levels. To your point about recent reports about us not adding many jobs and the Fed being concerned about that. The translation, for those that don't know, is if the job market is weak, lowering rates, which is what increasingly people think they tend to do later this year, lowering rates helps encourage businesses. It's more likely that businesses will borrow and expand and hire more people, therefore, if rates are low. Now, whether that translates into a lower mortgage rate or not by lowering that Fed funds rate, yes, there is that positive correlation. Generally, the lower the Fed funds rate goes, the lower mortgage rates tend to go, although that isn't always the case. To your point, Shaylee, late last year, there were 3 Fed funds rate cuts, and mortgage rates actually went up, which is somewhat of an aberration. That usually doesn't happen that way. But that's the environment we're in. Most people think Fed rate cuts are coming later this year.
Yeah. And I would say, the other thing too, when we talk about the pressure that the Fed is under right now, specifically Powell, he's being attacked, fine. And whether I agree or disagree, really important for listeners to understand that the indifference that the Fed is supposed to have, right? Bipartisan, it's not supposed to have a dog in that fight. If it did, the calamity, I think what would happen economically in this country would be devastating if other economic powers were to see that our particular financial institutions are swayed one way or another politically. That would be devastating to us. So I think Powell has done a decent job at staying the course. He's continued to do what he says what he does. So far I'm okay. Is he late to reduce rates? I don't know that I'm qualified to say that. I maybe, but at the same time, I think that his impartiality is been consistent, and that for that part of it, I'm grateful.
For those that don't understand, if Trump just told Powell what to do and Powell followed Trump's orders, how does that devastate the economy?
It shows partiality to or fealty to one particular party, right? It's not an independent institution where financial policy, quantitative easing, quantitative tightening, all of those different things that are necessary to keep the pistons pumping, it isn't. It's very specific to Fieldy and the leader of telling based on potentially ego or other elements that have not a lot to do with fiduciary responsibility.
If Powell did everything Trump said, I feel like we would have negative interest rates right now.
And that would be, yeah, that could be a problem, especially if the economy and inflation is on the rise. And then you get the tariffs. I mean, there's so much layering to this. I mean, we could go on and on about it. But overall, I think that interest rates are probably on the run, if I had to guess. Now, there's all kinds of variables that could make that statement untrue. But overall, in the next year to 2 years, I do think we'll see some relief in interest rates, barring any major catastrophe. But again, investors, if your success, if you're tying your real estate portfolio, your real estate investing, whatever modality you're interested in, if you're tying that to an interest rate and there's a certain number that you have ethereal in your mind, you're going to lose. Interest rate is a component of it, but it should not be tied to your success or failure. You should be able to do the math and look at the differences in real estate opportunities, investment, whether it be long-term, short-term, mid-term, single family, 2 to 4, appreciation, cash flow. All of those things should be considered, and you will find adequate returns independent of an interest rate if you're diversifying that way.
There's more evidence that Americans have warmed up and gotten somewhat used to normal mortgage rates, this normalization of mortgage rates. They are pretty close to their historic norms. In fact, a recent housing sentiment survey done by Turbo Home found that in Q1 of this year, 41% of homeowners surveyed said that a 6% mortgage rate was the highest they would accept on their next purchase, right? That was back in Q1. Today, up from 41%, 52% of respondents now say a 6% mortgage rate is the highest that they would accept. Evidence that people are warming up and normalizing this.
Yeah. And the other thing too is the pandemic rates, right? That's been a very hard shell to crack. The people that got these 2 and 3% interest rates during 2020, 2021, part of 22, they're really reticent to let those go. And I think that they're doing themselves a disservice as a result. If you can get a second lien HELOC, okay, fine. But overall, if you're just going to let that untapped equity sit, it's going to be to your disadvantage if you have any desire to increase your portfolio and your long-term financial stability and wealth.
You can watch this one next.